we all have three buckets of wealth. So bucket one's our monthly income. So we look at that and, project what is it now? What do we think it's going to be in the future? Bucket two is, the retirement nest egg. What have you saved? Do you have money in IRAs, 401ks, cash value life insurance, these types of things. And then bucket three is the house, all the equity in the house. And so that's kind of the overview of every client conversation that I have. And then we just kind of go from there.
Hey everyone, super excited to have you join us today. Today I'm talking with Michael Joy. Michael Joy is a reverse mortgage loan officer expert in the field. And this is a topic that is not talked about nearly enough. So we're going to get into everything reverse mortgages. Michael has been in the mortgage business for 31 years. He did regular forward mortgages for the first half of his career. And then for the last 12 years, he saw such an missed opportunity out there in the market. He decided to become a reverse mortgage expert and join the top team in the country. So it is just an honor to get to interview him today. And I think that you are going to find so much great information in this interview. Also found out that Michael is a fellow Western Washington University alumni, as am I. So we've had some fun talking about that and mutual professors we had. So both come from a finance background. Michael, thank you so much for joining the show today. So excited to talk to you about everything reverse. As you and I were talking before the show, this is an area of lending and mortgages that is not talked about enough. There's so many misconceptions in the market about it that is just flatly incorrect. I thought credit had a lot of misconceptions that are out there, but I think reverse mortgages, there's even more. So I would love to kick off the show with you sharing about what are reverse mortgages? What are some of the biggest myths and misconceptions? And what is it people really need to know about them?
Yeah. Well, thank you so much for having me, Carice. It's wonderful to be here. And yeah, I go back to when I first learned about reverse mortgages in 2014. And, here I am myself, super skeptical, like pretty much everybody I encounter in this space. Because, the program's been around since 1988. Mm-hmm. So, Reagan was the president. It goes back that far when it started. Wow. Yeah, it's been a while. And, the vision for the program when it first started was loan of last resort. And that's always kind of carried that stigma ever since that time, where you've got all this worth in your house and, you get to retirement and, you're on a fixed income, you're not working anymore. Mm-hmm. But, you've got this house that's paid off and it doesn't make more sense to access it. And in some cases you need to access it because, you didn't save enough, which a lot of folks unfortunately don't. I mean, so anyway, that's where I started, learning about the program back in 2014. And, it kind of goes back to at Western in the late 80s, early 90s, when we didn't meet. We were a couple years off from each other, but I knew nothing about reverse mortgages, didn't learn anything about them, thought I was going to be a financial advisor, got into mortgage, started making a paycheck and just never left. But when I met our director, Harlan, back in 2014, started thinking and started really getting excited with being able to change people's lives in a different way. Mm-hmm. And, it kind of goes along with the concept or the mission statement of our company now. We exist to love and value people. Yes. And with this product, I feel like that's what I'm doing. I'm changing lives for people.
Yeah. Well, that's the thing. People don't know what they don't know. So share what is the definition of a reverse mortgage? How is that different than a regular forward mortgage that people would think of?
So the primary difference is instead of spending cash every month to make a mortgage payment, you're simply spending equity. So as soon as you take out a reverse mortgage, monthly payment goes to zero. Mm-hmm. You no longer have to make a mortgage payment. And The average person in our country, 2/3 of their net worth is tied up in their real estate, tied up in their house. Well, you get to retirement, and does it make sense to continue turning cash into equity? Roughly 50% of people, when they get to retirement, still have a mortgage, 50% have a paid off house.
Yeah.
Well, for those that still have a mortgage, does it make sense to continue turning cash into equity?
That's kind of the gist of it. Yeah. And I think there's been a lot of misconception out there about what reverse mortgages are. So, obviously with the forward mortgage, you take this mortgage, you have to make payments for 30 years, 15 years. And the old school way, and still some of the old school financial people like the Dave Ramseys are like, pay it off, get your house paid off. The reverse mortgage looks more at using it as a wealth tool. So you have to be 62 years old to be able to get a reverse mortgage. Tell me why, what are some of the main reasons of what are the advantages? Why does it make sense for somebody who's kind of nearing 62, looking towards retirement, has a lot of equity? Why is that going to make sense for them to go ahead and do it?
Well, it makes a lot of sense. Let me go back to the misconceptions for a second, because I don't think I touched on that. I skipped right over that.
No, definitely.
So by far the biggest one is people think the bank owns your house when you do a reverse mortgage.
Yeah.
And title doesn't change at all. You still own the house, doesn't change, still in your name. And at the end of the line, when you decide to sell the house or you've passed away, all you have to do is pay off the balance within a year. That's it. So there's never a prepayment penalty, any of that. So that's by far the biggest misconception is, and it used to be that way when the program first came out, when Reagan was president, and then the current version really got changed in 2014, 2015, about the time I started learning about it.
Okay.
But the program used to not be as solid as it is now. So the last 12 years or so, it's completely a game changer. Seniors are protected. There's a counseling session that they actually have to do. That's
before they get the loan.
Before they get the loan. That's designed to be a senior protection to make sure, hey, you're dealing with a reputable company. You've still got your faculties about you. You know what you're doing. And these counseling agencies have no financial interest whatsoever in what the senior's doing. So it's a good thing, because as we know, there's a lot of bad actors out there. Now, as far as your question, why would people potentially set up a reverse mortgage? I mean, there's a lot of different reasons. And how I like to start every conversation, when I'm talking with a client or a financial advisor or a realtor that might have a client, we all have 3 buckets of wealth. This is kind of how I like to frame the whole conversation. So, we've got bucket 1, which is our monthly income. And obviously, as we go further into retirement, when we're working, we always anticipate our income's generally going to be on an upward, trajectory. We're going to generally make more, ideally, till we get to retirement. And then, hopefully we've saved enough. We generally have Social Security coming in, maybe a pension, although that becomes more and more rare the older we all get. So bucket 1's our monthly income. So we look at that and, project, what is it now? What do we think it's going to be in the future? Bucket 2 is, the retirement nest egg. What have you saved? Do you have money in IRAs, 401ks, cash value life insurance, these types of things. And then bucket 3 is the house, all the equity in the house. And so that's kind of the overview of every client conversation that I have. And then we just kind of go from there and figure out, what might make sense. I mean, what are the client's goals? Are they in their forever house? That's another big one. Yeah.
Because they can do a refinance on the house they own. So I've in the cases that I've had where I've referred them to you, I've had clients that were kind of nearing retirement, or that's 62, or they were 62. They have a ton of equity in their home, and they're kind of looking towards retirement going all right, I've got, a limited amount. Like you said, I've got money in 401k, money in IRA, but the majority of their wealth is tied up in their house. And one of the things I am big on, that I give advice to clients on, is always keep your money moving. Idle money doesn't help you. It is dead equity. It is dead to you when it's not moving. So for these kind of people, it can help them. I'd love to have you walk me through like that scenario. Let's say you've got a client owns a house, $1 million house, and they owe $200,000, or maybe they even own it free and clear. What's the kind of options that you would present to a client in that kind of a scenario? And let's say they just turned 62.
Yeah. Yeah. So great question. So for a client that just turned 62, they're going to have the ability to create a bucket of money. So again, I think about the 3 buckets. So think about it as a bucket of liquidity. Mm-hmm. So we'll say they're going to have $300,000 of available cash that's going to be attached to the house that they can utilize, that they could save there for a rainy day. And what that looks like is, we know the bucket of money is $300,000, or, round number. It's going to be somewhere in that ballpark. Age comes into play, but for this borrower, 62, it's going to be somewhere around that.
Okay. Because there's like kind of a mathematical equation you run through with the equity, what their max loan amount is for the amount of cash or line of credit they could put against the house, essentially.
Yeah,
okay.
Yeah, correct.
Okay.
So where age comes into play, so any reverse mortgage, you're guaranteed that you're not going to have a mortgage payment until the younger spouse, in the case of a married couple, is 150 years old, 150.
Wow. Okay.
So that's yeah. So that's how the Federal Housing Administration could say, hey, we guarantee for life that you're never going to have to make a payment.
Okay.
And that it doesn't matter how long you live. Mm-hmm. And this bucket of money, as soon as you turn on this bucket of money, it's going to continue growing tax-free. It's somewhere, we think, between 6 and 7% a year.
Okay.
Indefinitely.
Yeah.
So you've got a $300,000 bucket of money at 62. Mm-hmm. If the rate's, 6 to 7%, that bucket of money's doubling every 10 or 12 years.
Yep.
So you're 73, we'll say, then the bucket of money's 600,000. At 84, the bucket of money's 1.2 million, and it'll continue increasing.
Yeah.
And that the availability of that money is federally guaranteed, backed by the Treasury. Mm-hmm. So regardless of what happens with the economy, regardless of what happens to the value of the house, that money, that liquidity is guaranteed to be there. Again, it goes back to seniors being a protected class.
Yes. And a lot of these, the thing is, the misconceptions go back to prior to those rules that went way back to the 80s and 90s that all changed you said around probably like the 2010,
2014, 2015 is when the major changes and safeguards got put into the program.
I think that a lot of people still are stuck back on the old rules that don't exist anymore, because that is one thing, when I've sat in on the trainings with Harlan and your team, they've educated me, and I've been in this industry 25 years. I didn't realize that no matter what happens in the value of the house, that senior is protected. Yeah. That's a piece that people do not know. And that's a piece that people need to know. And the value being able to take that money, that $300,000 you're talking about bucket, they can give that to their financial advisor. Their financial advisor can then invest that for them, and they've got the availability of using that money. So if somebody's on a fixed income or is scraping by, that gives them another income stream to live on.
Yeah. And with the whole financial, so for clients that have a financial advisor, these are the scenarios that get really exciting, because you're creating this buffer asset, right? So if you've got a paid off house or close to a paid off house, going back to the $300,000 bucket, if you can create a $300,000 bucket of liquidity that's tax free and use that as a hedge against market risk, so that we'll say, generally speaking, the stock market goes up most years. And this is all based on math and, financial advisors that have written books on sequence of returns risk is the term, to look up that talks about all this. But the theory is, in simple terms, you pull the money out of your house in years where the market's down. The worst thing you can do is after you retire, if the stock market drops 20 or 30% in a given year, which periodically it will do, it always comes back. It always has.
Yeah.
And it will come back. We all feel like, I think it will.
Yeah.
But the worst thing you can do is pull a bunch of money out when you're early in retirement after the market's, value has dropped considerably. Pull the money out of the house. Let your assets recover, then resume pulling the money back out of there. And 2/3 to 3/4 of the time, after thousands of simulations, that the most prominent researcher, his name's Wade Pfau, Pfau.
Okay.
He's written books, very dry read. wouldn't necessarily recommend reading them. But the conclusions are that 2/3 to 3/4 of the time, you're going to have a larger legacy of wealth at the end of your life with a reverse mortgage versus not having one. And that really surprises a lot of people.
I think it probably would surprise a lot of people that are not in the financial realm, but it really comes down to compounding and the power of investment, because, it's that old school pay off the loan, like get down to a 15-year, pay more towards principal, get that loan paid off as fast as possible so you have a free and clear house by retirement. But the challenge there is then you've got this dead equity. And, sure, like you said, you're now pulling from assets that are in the market that's going to fluctuate, that would make you a lot more money if you could keep those funds in the market. So it's just a better use of making your money work for you. Like, I love the saying, like, make your money work harder for you than you did for it. Yeah. So it's a great mechanism. I think where people get confused is they don't understand, because I've had clients like that just say, well, give me the concept of exactly like what a reverse is. And they don't get that concept. Like, if it's a home they currently own and they own it free and clear, that effectively you're putting like a line of credit on the house. Can you kind of walk through how that works, and then talk about the legacy of that? Like, let's say, down the road when they do pass away, how that, how the heirs come in, or how a surviving spouse comes in to that picture, and like play that out so people get a really clear picture on that.
Yeah. So great question. I mean, scenarios are always good to visualize, and that's obviously I think that's a great way to learn. So we'll go back and use the same $300,000 bucket on the $1 million house. So if that client's 62 and, we know that bucket of money, we'll say at 82, it's doubled twice. So it's $1.2 million that they've got in this bucket of money. Mm-hmm. Well, they've been in control of how they use that bucket of money the whole time. Yeah. So it's going to grow regardless of if you owe $1,000 on the loan or whether you owe $1 million on the loan. The whole bucket's compounding at the same 6 to 7% rate. We as the bank are only going to collect interest on whatever they've borrowed. We're going to actually credit them growth into their available line of credit on the rest of it, which is huge. And again, it doesn't matter what the value of the house is. Wow. If the value of the house stays flat, if it drops, the universal assumption is that we assume the house is going to go up 4% a year in value. Okay. Which
can be pretty conservative in certain areas. So that's a pretty conservative growth rate for around here.
Yeah, it is. And that's a nationwide number. But, obviously we've seen housing corrections before. And I go back to 2007, 8, 9. Yes. Here I am working in the mortgage industry. I had my own broker shop leading into the crisis. And as soon as that happened, it was chaos. And fortunately, I survived it and worked my way through it because I wasn't living beyond my means at the time, which a lot, about 90% of our competition was gone at that point.
That's how I survived it too.
It was rough.
We knew to save so that we could get through it.
But to answer your question about the line of credit, I had a line of credit. I didn't owe any money on it. Yeah. And I couldn't pull the money out before they froze it. Mm-hmm. After the value of my house dropped.
That's the thing people don't realize. On forward mortgages, in that fine print, the devil's in the details. Mm-hmm. In those details on the deed of trust, it says, or on the note, it says right there, they can freeze that line for basically whatever their reasons on.
Yeah.
Yeah.
So for a senior, especially, I think for thus, those of us that are still in our working years, a line of credit's great. If you need liquidity for something, it might make more sense to pull it out of that. But when you get into retirement and your options become more limited because you're no longer working, and you might have this money there and feel like, well, this is my safety net. And if the bank can freeze the safety net at their discretion, that's not really all that safe.
No.
And the flip side of it is with a traditional line of credit, for a senior, it's kind of like a snowball effect. You start borrowing money on it because you need the money. Well, your payment keeps going up.
Yes.
And you got to make that payment every month.
Yeah.
Obviously, with a reverse mortgage, the only time you have to make a payment is within a year of, either passing away or when you pay off the house. You just pay off the loan, but you don't ever have to make a mortgage payment.
Yeah, it just gets added to the balance, and that line of credit never gets frozen on a reverse mortgage. So
Correct.
It doesn't matter if we had another financial crisis, the reverse mortgage clients are secure.
Yeah, and beyond secure. I mean, I even learned something this time last year with the horrible fires down in Southern California. Clients that had a reverse mortgage line of credit against their house, even though their house was gone, if they had money in their reverse mortgage line of credit, it's federally insured, it's federally guaranteed, they still had the ability to pull some money out, to pull the money out if they wanted to. They had the house insured, it was going to rebuild, they weren't moving somewhere else, they were temporarily displaced, but they still had access to the money even though the house was gone.
I did not realize that. That's a big one.
Yeah. So I've got a financial advisor in Southern California that I work with, and he was completely blown away when, a client that we had set up with a reverse mortgage that lost their house actually still had access to the money in the line of credit. And it turns out, again, that's not something we even think is going to happen.
Right.
A disaster on that scale, but with a traditional line of credit, obviously, it would have been frozen.
Yes. Or, this is the other thing I think people don't realize. For those people in those California wildfires or even other natural disasters, if you have a regular mortgage, you still have to keep making the payments. The bank doesn't halt your requirement to make the payments just because a natural disaster happened. And I mean, sure, you can call the servicer and talk about hardship options, but they don't automatically halt it. That's the thing, is I think people don't realize. Yeah. So then when somebody passes, or let's say it goes to the surviving spouse. So that surviving spouse, talk about how that works. Like, do they get to keep the loan? How long do they get to keep the loan, stay in the house?
Yeah, great question. So this is one of the things that got fixed back in 2014 and 2015.
Okay.
As a younger spouse wasn't always protected before.
Okay.
Now they have to be protected.
Yeah.
So even if the younger spouse is, 50 years old or 40 years old, whatever, very, younger spouse, one borrower has to be 62.
Okay.
The other one could be, 35. It doesn't matter.
And they can still be on the loan with
the loan's guaranteed until the younger spouse is 150.
Okay.
And here's the great thing about it too is you can never, it's a non-recourse loan, which means that nobody is personally responsible to repay that loan. So, I like to, in simple terms, explain it to clients that you're guaranteed not to lose when you have it, because if there's equity left in the house, when you decide to sell it or you've passed away and it's your estate dealing with it, you sell the house, pay off the loan balance and your estate, or you keep the difference.
Yep.
If there is no equity left because you live till you were, 105 years old.
Yeah.
And, because when we project these things out, generally speaking, if somebody is not going to make any payments on their house, that bucket of money we think is going to equal the property value somewhere around 100 years of age.
Okay.
Not exact, but it's usually right around there.
Okay.
So, and that's assuming, again, the house is going up at 4% a year. But what if the house doesn't go up at 4% a year? Or somebody lives for a super long time? And we'll throw a crazy number out there and say the bucket of money's grown to, $3 million at the end of somebody's life and the house is only worth $2 million. What happens? Well, the client, before, as long as it's before they pass away, they can pull out all $3 million if they haven't already. It's tax-free. It's guaranteed to be available, regardless of what the value of the house is. So, and that's where the mortgage insurance comes in. So there's mortgage insurance on these loans, and it's different than a traditional mortgage insurance on a forward loan, what I refer to as a forward loan.
Yes.
In that all the protections are there for the senior.
Gotcha. Because on a forward, the mortgage insurance protects the lender. On a reverse mortgage, the mortgage insurance actually is there to protect the senior. That's a big distinction. That's a big distinction people need to know.
Right. It is. And, in that example, if the client owed $3 million and the house was worth $2 million and they had passed away, their estate can either do a deed in lieu of foreclosure. They can keep the $3 million, give the bank the keys and say, hey, the house is only worth $2 million. Or if they want to keep the house, they have a federally guaranteed first right of refusal. They can buy the house for 95% of what it's worth. Federally guaranteed first right of refusal.
Wow.
So mom and dad owe $3 million, house is worth $2 million. They can buy it for 1.9 before it goes on the market if they want to keep it in the family.
Or they can just say, I'm walking away. Here's the keys. And they're not responsible to pay.
Correct.
See, and on a forward mortgage, you'd have to sell that in a short sale.
Right. And there's, maybe a deficiency judgment.
Yes.
There's none of that on a reverse.
Well, it would likely come after the estate if there was money in the estate to cover the difference. So that's another big distinction between a forward mortgage, regular mortgages that most people think of, versus the reverse. That's a misconception that people do not realize that.
Yeah.
Was that one of the things that also changed? Or has that always been the case?
That's always been the case.
Okay.
But the title, way back, you used to give up title to the house, but again, you don't anymore.
Oh, okay.
So the title stays in the family's name, whether it's individually, a trust, whatever. Nobody's responsible to repay the loan. So as soon as you take out a reverse mortgage, you're offloading 100% of the risk of the future property value onto the federal government. And, the loan's not free. I have clients tell me all the time, Mike, this sounds too good to be true. What's the catch? And I'm like, there isn't a catch. It's too good to be free. It's not free. There's some cost of setting it up. Yeah. Just like there is with every financial product, right?
Yeah.
And, the mortgage insurance is the largest cost, but again, it's providing that benefit that you've got this guaranteed access to this pool of tax-free money.
Sure.
That's not considered income. It's not taxable. It doesn't impact, somebody's tax bracket, whether they qualify for, a property tax exemption, any of that stuff. It's not income. They're just borrowing it from themselves.
Yeah. Well, and that's interesting because what a difference it is on the mortgage insurance side of it. Well, and the qualification. So this is a piece I think consumers don't realize. Behind the scenes, we have to underwrite these files, right? Like we're looking at property, we're looking at income, but on reverse mortgages, so on regular forward mortgages, we have to look at the income of the borrower to make sure they qualify for the payment. But with reverse, correct me if I'm wrong, because there's no payments, you're not looking at the borrower's income. What are the items that you're really using to underwrite that loan file?
Yeah, so the income qualification's a lot lower because there's no mortgage payment. We still do, and this is part of the changes, again, that came out in 2014 and 2015. So we do have to show that a client has enough income to cover the taxes, the insurance, the HOA, whatever their other debts are. Sure. And then we factor in, a cost. It costs something to own a house. So we factor that in, and there's a residual income requirement. So for a couple, it's roughly $1,000. We just have to show they've got at least that left over at the end. But, if they've got extra equity in the house and money in the line of credit, that obviously will provide an income and things like that.
Okay.
credit score is not important from the standpoint.
Interesting.
Payment history is important. So
Okay.
again, back to protecting seniors, prior to 2014 and 2015, there wasn't any of this assessment that was made.
Okay.
Now there is. So we've got a 2-year look back where, are you paying your bills on time? Are you remembering to pay your taxes, even your HOA dues? Because those are things that we all have to do to keep our homes out of foreclosure. We got to
Right.
pay our property taxes
Yeah.
and at least our HOA dues. At some point, that's going to become a problem for people if they're not paying them.
Yeah.
And so those are the things that most clients have to do when they have a reverse is, we've got to show that they've got the capacity to pay those. Because in most cases, because there's no monthly mortgage payment, clients are going to pay the taxes and insurance on their own. We can set the money aside to pay them. And
Like for an escrow account.
for an escrow.
Yeah.
So, and I have clients that have done that, either they're not great with their money and they just, hey, they don't want to have to budget for it. That's,
Yeah.
if they have enough equity, it's a great thing because it's still part of that bucket of money. It's just earmarked to pay the taxes and insurance for their life expectancy.
Yeah. Well, yeah, because we all know that the only thing that trounces a mortgage lien on the title of the house is an unpaid tax lien, delinquent taxes.
Yeah.
And our HOAs can also have senior, status over mortgage liens. So as lenders, we got to make sure that the HOA dues and taxes and got to make sure there's insurance on the house. So
Yep.
yeah. One of the concepts that you've talked about that I would love to talk about is reverse for purchase. And I think that this is something people don't realize, that you can purchase a home on a reverse mortgage. And it's a great tool for realtors. I know I've talked to a few of my realtors about this and they were like, wait, I didn't know that you could do this. They called me with a scenario of a client. I don't think she's going to be able to afford anything. Well, she's of retirement age. Yes. Why don't we see if she might be a candidate for a reverse for purchase? So please tell us about that.
Yeah, no, it's very, reverse for purchases are amazing. They really are. And part of the issue we've had, I think, with the housing market, obviously, the last few years is we've all got these insanely low interest rates for those of us that have mortgages. And so there's a lot of fear with, getting rid of that. A senior's not going to want to turn in a 3% rate for a 6% rate in most cases. So what it really comes down, so they might be staying in the wrong house. Right?
Yeah.
Whether it's 2 stories, there's too much yard upkeep, whatever the scenario is, there's a lot of seniors that are in the wrong house because they don't feel like they can move. And, so what the scenario looks like is, and I've got, software that I go through with agents and clients to really model this out quickly. But say that their current house is worth, $750,000. And they still owe, $200,000 on it. So they've got $550,000 of equity in this house. Well, they're not going to be able to, they're still paying a loan, probably at 3%. And they're not going to want it. And they know, okay, I can't take that 550 and go buy a house that I want to age in for the rest of my life. So I'm just going to stay in my $750,000 house because they've got in their mind that, well, my payment's going to be way higher, based on a 6% rate. So I'm just going to, hunker down and stay in this house, even though it's not perfect. And so with the reverse for purchase, the loan to values work the same, so a client's going to turn around, this client with a $550,000 net proceeds from their sale, they can turn around and buy a house for $800,000 or so. Roll in the 550.
The equity from the house they just sold. Yeah.
Yeah. And use the reverse mortgage to cover the rest of the purchase price. So not only have they moved into a house that they really want to be in, closer to the grandkids, Rambler, whatever the scenario is, and they don't have a payment anymore.
Yeah.
You get rid of a $200,000 loan and the payment that was associated with that. All they did was roll their equity into this new house, but their monthly cash flow. I mean, that's really what the whole program the benefit is from a cash flow standpoint, especially for anybody that has a payment.
Right.
Getting rid of that payment is a huge, huge deal.
Yes. Yes. And like you said, what you're doing is like that, instead of taking money out of like a stock account or checking savings that you're taking it from the equity is what you're doing. It's a better use of the money. You're keeping your money working for you.
100%. And I'm glad you brought that up, because I had this exact scenario a few months ago with a client where he had, a couple of $1 million of investments and net worth and everything else. He was planning to pay cash for the house until the advisor brought him to me, and we looked at it and said, well, you're going to get killed on taxes when you liquidate all these investments to pay cash for the house, because he was upsizing into a more expensive house. So his equity wasn't going to cover the whole purchase price. He was going to be liquidating. And actually, he didn't want to sell the house first. He wanted to buy the new house first, which a lot of clients, do.
Right.
And so we leveraged the reverse mortgage. He pulled out some things that weren't taxable, CDs and some lower risk stuff that he had, and didn't have to sell the Apple stock that he had for the last 30 years and the Microsoft and, whatever, which would have really increased his taxation. So, there's a lot of tax benefits to having a reverse mortgage as well. I mean, it's huge, but the purchase scenario, it blows me away that it's not more well known.
Yeah. And I think there's such an opportunity here for financial advisors and realtors. And I mean, look, I know some phenomenal financial advisors and I know some phenomenal realtors. And I think it just comes down to people don't know what they don't know. And they're still anchoring to some of those old misconceptions prior to 2014 that are not the case anymore. But there's some phenomenal opportunities for both of these referral partners, that we work with all the time, that they could really be helping a lot more clients and serving them with more options. I would love to have you kind of share because you work a lot with financial advisors. Talk us through like some of the biggest benefits that the financial advisors that really do understand these reverses, how did they talk to clients about it? And how did they advise about it? Just to give people some ideas.
Yeah, I think with financial advisors, it really starts with, the average financial advisor doesn't even consider housing wealth in the equation. I mean, and that's really the thing that's broken with the whole model is they're just looking at the retirement nest egg, the traditional nest egg, the IRAs, the 401ks, the cash value life insurance, the annuities, that kind of thing. They're completely ignoring. I mean, seniors in this country have over $14 trillion in home equity.
Yeah, it's insane.
Which is a mind-boggling number.
It's insane. It's an insane amount.
I mean, and all the home equity in the country is about 35 million, but 14 trillion is just for those over age 62.
Wow.
And so, again, that's where most, or certainly people have a significant part of their wealth is in that. So really what's broken is most advisors, and I've seen a huge shift over the 12 years I've been focused on reverse now. 12 years ago, advisors were like, nah, we just ignore the home equity. We think reverse mortgages are bad, but there's been a lot of advisors are a lot more open-minded now, especially the younger ones that are getting into the business. They're eager to learn, and they recognize that, hey, why are we ignoring this $14 trillion? That's a huge deal. And if studies and research from our own industry show that it makes sense to utilize this, not as a loan of last resort, but as part of a comprehensive financial plan.
Yes.
It's a big deal. It's just really getting the education piece out there. Certain financial advising companies, their compliance department,
gotcha.
They're scared of recommending a reverse mortgage product because on some selfish level, that could mean that the advisor has more assets under management, especially, so there's a little bit of reluctance and fear from that standpoint, but honestly, if an advisor is truly a fiduciary for that client and is really looking out for their best interest, they absolutely should be considering the equity in the home as part of the overall picture, because there's so many uses for it in financial planning. I mean, there's a myriad of options, whether you're setting up that bucket of money as a hedge against, expensive long-term care bill, years down the road. Most people don't have long-term care covered.
No. They'd have to self-pay.
Yeah.
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 And so, nobody wants to pay for long-term care insurance because it's expensive. So setting up the bucket of money against the house, especially for somebody that has a lot of excess equity, maybe they have the house paid off, it's a no-brainer. You can defer your Social Security. So somebody that's early in retirement, a lot of times in this, Social Security is a big deal for a lot of people, because the average person I talk to doesn't think, well, what happens if, my wife's name is Stephanie. If I got hit by a Mack truck when I was 65 and I died, well, she's only going to get one Social Security anymore going forward, right? Instead of two. She's going to probably keep mine because it's going to be higher. But that's something that the risks of our shocks to our income as we get further into retirement are they're high. I mean, the chances of our income going up aren't real great.
Right.
So, you can defer your Social Security. If somebody wants to retire at 62, in most cases, for somebody that's healthy, at least it makes sense to wait to claim your Social Security until later, when it's actually
Till you're like 70
escalated.
or plus.
At least to 67. And then, financial advisors can work their magic and figure that out. But if you can leverage the house and pull money out and wait on one of the Social Securities, that's a big deal. Rolling money over, possibly out of a taxable place like a traditional IRA to a Roth, paying the tax from the proceeds of the house instead of from within the IRA. That's a huge benefit. I mean, taxes are historically pretty low right now.
Right.
So there's a myriad of different things that you can do. And there's some higher level tax strategies that, our director, he figures he's had his own reverse mortgage for just a handful of years now. He already figures his net worth is higher by a couple $100,000. I just heard him talking about this week, because he has one, and because he's strategically making payments to the reverse mortgage to generate tax deductions in certain years.
I would love, you and I talked about that a little bit offline. I would love to get into that, because that kind of goes into, there's some things you really can do that are very tax advantage. And it kind of goes to the whole, if you're younger than 62 and you're kind of preparing for this and you're kind of thinking through this, you're saying, don't go and pay that 30, don't go get the 15-year, don't put a bunch of money against your 30-year mortgage, don't go pay it off, because of these opportunities that, you were talking about with Harlan. I'd love to have you get into that a bit more, into the weeds in that, because I was fascinated by it.
Yeah. So, like you mentioned Dave Ramsey earlier.
Yeah.
Dave Ramsey is, very wrong when it comes to reverse mortgages. Honestly, he absolutely is.
There's many things he can be a little bit off on.
Yeah, he just. On a basic level, he's got great financial advice for clients, right? Pay off your debt, don't be in debt. These kinds of things. But mortgage debt is actually good debt.
Yes.
And when somebody pays off their house, they forever, as long as they live in that house, they forever forego the ability to write off interest on that house again.
And that's the thing I think people don't understand.
Yeah.
So once they've paid off the loan, they forever lose the opportunity to write off interest again on that home.
Yeah, and this was part of the Tax Cut and Jobs Act in 2017. So as soon as you pay off the house in full, it can't. So the magic words are acquisition indebtedness. So if you can tie the fact that your mortgage goes back to when you bought the house or you've always had a mortgage on the house, you can write off interest on that house still.
Up to the $750,000, I think, right?
Yeah. But as soon as you pay the house fully off and pull the money out on a cash out refinance to go buy a boat or a car or whatever, it's no longer tax deductible.
Yeah.
So with the reverse mortgage, as long as you haven't, and personally, the only reason I don't have my reverse mortgage yet is my wife and I are going to be 56 this summer.
Okay.
So we're not quite there.
Not quite there.
But as part of our plan, as soon as we turn 62, absolutely not going to have the house paid off on purpose.
Yep.
I don't care that I'm turning in the 2 3/4% interest rate, getting rid of that because the tax benefits are huge. So what that looks like is you can let your interest stack up on that loan. So most people, for a couple in retirement, the standard deduction typically is $32,000, $33,000 in retirement. So most people aren't even claiming their mortgage interest deduction anymore. They're just making 12 payments a year because the standard deduction is so high, especially for a married couple.
So it doesn't make sense to itemize. They just take the standard. Okay.
Yeah. So with the tax stacking strategy, and our director, he's the one that came up with it. He's written a white paper. You can find it on NASDAQ.com talking about the strategy. But what it looks like is most of us have put our money away pre-tax, right, in our 401ks, and we've kicked the can down the road and not paid the tax when we save the money. So we're going to be taxed on it when we pull it out in retirement. So what that effectively looks like is you get your reverse mortgage. You can always make payments on your reverse mortgage, but most people don't. And those that are, that have the means will strategically make payments on the reverse mortgage. So for a round number, let's just say in 3 years' time, you've had $100,000 accrue on the loan. It's a good sized loan, obviously. Maybe it's 4 or 5 years, but somewhere in there. We'll use $100,000 for a round number. So step one is you pull $100,000 out of your tax-deferred IRA.
Okay.
You're going to obviously get a 1099 at the end of the year that says you pay, you got $100,000 of income. Step two is you're going to make a $100,000 optional payment to your reverse mortgage.
Okay.
You had the upfront mortgage insurance that you paid for.
Yep.
That's now tax deductible. And you've got, the interest and the 0.5% mortgage insurance accruing on the loan. So the loans, you're not making any payments. So these things are accruing on the loan balance. So, typically you let the accruals get to where they're at least twice the standard deduction in my mind.
Okay.
Right. So somewhere between 60 to 100,000, say.
Okay.
So go back to the easy math of 100,000. And so you pull $100,000 out of the IRA. Obviously that's income. You make an optional payment of $100,000 to your reverse mortgage. As soon as you make that payment, your loan balance drops by $100,000.
Right.
That $100,000 immediately shows up in your line of credit that's tied to your reverse mortgage.
Okay.
That you can pull back out, whenever you want down the road. But what you did is you gave yourself a 1098 at the end of the year.
That offsets the income. So now you don't pay any taxes on the $100,000 distribution that you took.
Yeah, you're essentially washing it with a dollar for dollar deduction.
Interesting.
So, and I'm always careful not to give tax advice. Sure. Clearly, I'm not a CPA.
We're not CPAs. People, so disclaimer, people should always check with their CPAs.
100%. We've
seen this strategy done successfully, we'll say.
It works. And there's white papers out there on it, and it works. I mean, most of us aren't using, it comes down to most of us aren't using our interest deduction. So why not strategically use it every so often so that you can pull some money out of these tax deferred places that you're going to be taxed on in retirement. So it comes down to that bucket of money just being very fluid and very, if you make payments into it, all that money is then available to be drawn back out. So,
that's the other thing that I don't know if people are aware of, that even if you you pay that $100,000 back against the mortgage, you can take that money back out against it because it's like a line of credit that's on the house. Like you can't do that on a first mortgage, a fixed first mortgage. Once you pay that loan balance, if you were to put that 100,000 towards a loan balance, it's paid. You would actually have to go take out a physical loan through a cash out refinance, through a line of credit to get that money. So on a reverse though, you could draw it back out.
100%.
Yeah.
100%. And this is one of the
Interesting,
things
yeah.
I love to model with the software that we have. It's so we can model, okay, here's what it looks like if you're making a $2,000 a month principal and interest payment on a traditional mortgage. Here's what it looks like if you're making a payment on a reverse mortgage. And the beautiful thing about the reverse mortgage is 100%, you made a payment you never had to make. So 100% of that money is going into a place of liquidity that if you want it back or need it back down the road, you can get it.
Yeah.
And this is a strategy I love to use with people that maybe they haven't retired yet. I mean, I recently had a client up in Everett where they didn't have nearly enough saved for retirement, like 45,000, and they're in their early 60s. And we're like, oh my gosh.
Right.
So, but they're making this $3,000 a month mortgage payment. So ultimately we got rid of the forward mortgage. They're still going to make held their feet to the fire and said, you still make this $3,000 a month payment because you're already used to making it.
Right.
And so they're saving $36,000 a year for retirement. That's in a place of liquidity. They were in the right house to stay in, to retire in, because we talked about the whole reverse for purchase thing. But if they were going to work for another 5 years, they've got, $180,000 saved inside of their mortgage, and it doesn't just sit there. It's growing at 6 to 7%.
Yeah.
For their future use, for their benefit. So $36,000, 5 years, 180,000 plus at compounding at 6 to 7%. They had over $200,000, which was over 4 times what they had saved in retirement. So
yeah, that's the thing. I think that people don't necessarily realize, like, as you're thinking towards retirement, and this is another opportunity for financial advisors, as you're looking at people's mortgage structure, because there's a lot of people that aren't going to be on track. They're not going to be having enough saved up between, their Social Security, their 401k, their investments, their IRA, but yet, they've got this home that is got a good amount of equity in it. And, using that, thinking ahead and using that as part of the retirement conversation to factor that in. It could really save a lot of people from, having a very average retirement versus really getting to enjoy life.
Right.
Yeah.
Yeah. And the key is just getting people to look at it before it's a loan of last resort. I mean, the loan of last resort, we're always happy to help those people, but if they would have done it sooner, all the studies show the earlier you do this, the better off you're going to be.
And why is that?
Well, you improve your cash flow as early as possible.
Yeah.
As for somebody that has a mortgage payment, the sooner you can quit paying that, put the money somewhere else. Even if you choose to still make the mortgage payment, you're still putting it into a place where the liquidity is better in the future.
Right.
There's just a myriad of reasons to do it because, again, as we get further into retirement, a lot of people are living longer now too. That's the other thing.
Yeah.
Social Security was developed a long time ago, and it just doesn't cut it for most people. And it also just breaks my heart when you see one spouse pass, and aside from the grief of losing their spouse, they're getting slapped in the face with the fact that they just lost, 40% of their income or whatever it was.
Right.
So, it's a huge deal. But even for people that have money, it needs to be part of the financial plan. And I feel like we're getting closer to that point, but there's still a lot of, there's still a really long way to go.
Yeah. Well, like we were talking about kind of some of the advanced uses, and we were looking at the early inheritance or like in estate planning, and I hear people tell me all the time, clients will say all the time, yeah, I want my kids to, they're going to get this equity that's going to really give them a jump start. And that's phenomenal. We want that. And that's where like the reverse strategy can make that even better. And I think that's a piece that a lot of people don't quite understand, that, using a reverse mortgage can really increase that goal and make that even better. Financial planners, CPAs, and we don't think anything of borrowing against the equity in our house if we're going to do a big remodel on the house. So we're going to invest back into the house, use the money that is already in the equity to pay for that remodel. Really what you're doing is you're doing the same thing, but you're investing in yourself. You're investing in your life rather than taking it out of other investments that are earning probably a higher rate of return. You're taking it out of the equity of the house.
Yeah. I mean, what do you feel like most of your clients, what do you feel like their kids are going to do with their house?
They're probably going to sell it. And they're not, it's not their deal. I mean, maybe if it's like a second home or if it's a vacation home that the family's gone to for years, they might keep that.
Yeah.
But likely the kids are going to sell the house. Yeah.
90+% of the time the kids sell the house.
Exactly.
So it's fascinating that we all learned very young to pay things off, to not, be in debt.
Yeah.
But we just have this mental block around our home equity and what are our kids going to do with our house anyway? Do we really want to give them the house, or do we want to give them what the house represents?
Right.
And, we want to give them what the house represents. And
Right.
in a lot of cases, there's a lot more efficient ways to transfer that wealth to the next generation than to give them a paid off house.
Well, the other thing too is like, if let's say you take parents that, their dream is to have a family vacation home. They want to buy a big vacation home where all the kids can come and visit them, and, they're going to get to enjoy that for 20 years. Well, if you eliminate the primary residence mortgage payment because you do a reverse mortgage, and now you eliminate the parents having to make that payment, the parents are now in a position to be able to invest in this second home for the family because they can afford that, because their cash flow is, instead of putting the payment on the primary, they now put the payment on the second home. It allows them to do that dream. And that's now the legacy too, that they're able to pass down to the kids. Not only the kids still get the primary, but they're also now going to get that second home as an investment, but also as the family legacy that was their family dream to do.
Yeah.
So.
Yeah. No, that's a huge thing. It's, I had a client that I'll never forget, this early part of last year. He actually verbalized to me, he said, Mike, I want to help my kids now while I'm still here.
Yeah.
I mean, he wasn't in the best of health, and he had this paid off $1 million plus house. Mm-hmm. And he's like, my kids need my help now. I'd rather be able to see them enjoy it. I mean, if I die, personally, say I die when I'm 85 or 90, my kids are going to be in their 60s. Do they really need my help then? I sure hope not.
Right.
I mean, they could probably use it before then.
Right.
And so it really just goes back to that mental block that we all have. It's like pay off our house and just keep it there idle doing nothing. But why is that? I mean, if we had $1 million in our, IRA with our financial advisor instead of in the house.
Yeah.
And the financial advisor said, well, that's sacred. You can't touch it because it has to stay that way. We go find a different financial advisor. It's like, I saved $1 million.
Yeah.
I'm retired now. I want to use it for stuff, but we just don't think about our equity that way. So it's kind of just changing that whole mindset is
You're
really
exactly
what we're talking
right.
about.
It's a mind shift change, because it makes such a big difference, as we know, if like the whole concept of gifting with a warm hand versus the cold hand. Gifting while the parents are still alive, so they actually get to watch it and see it and see the joy in what they've helped their kids do. Yeah. But if those parents can gift 2 decades earlier, what it does financially for that generation is massive. I mean, it's massive. They're so far ahead of the game. And like you said, they're just, instead of giving them the equity when they die, they're essentially given the equity 20 years earlier. And now these kids get to start building their wealth, which, I mean, that's a huge difference. Yeah. And I'm seeing that. We're starting to see that trend a lot more. It is just a mindset shift though, but I would love to get a lot more financial advisors on board, really understanding. And that's the thing we do. We are so fortunate with your group. Like, you've got the best team in this business in the nation, #1 team in the nation. And we do regular monthly meetings, like Zoom meetings, webinars, where financial advisors, you guys educate them on exactly the tools and how they can use this in their business to better serve their clients. I'd love to have you talk a little bit about that.
Yeah. So it's a big deal because that's all we do. So the model we have here obviously is I can't do forward loans anymore. So if I've got a 35-year-old that wants to buy a house, hey, call Carice.
Yeah. And I'm the same. I'm reverse. I refer them to you guys.
And it makes a big difference. I mean, I was doing both until 3 years ago when I decided to, stop managing 2 branches and trying to originate every loan that came my way to simply focusing 100% of my time and efforts towards reverse mortgages. Yeah. It really makes a big difference because it's a hybrid between financial planning and mortgage. I mean, it's honestly probably more towards the financial planning piece of it than it is a traditional mortgage, which is why I really decided to scratch that itch and finally chase what I went to school for back in the late 80s, early 90s. And so that's why I'm loving it so much. And I really feel like I'm helping people and I don't even care about the money. I don't even think about what I'm earning. Obviously, I don't work for free. None of us do. Sure. But that's not why I'm doing it. I don't even think about that. It's just how can I help this person make sure that they've got building their most efficient retirement. Yeah. And so I love working with these advisors that especially are open-minded enough to, the housing wealth deserves a seat at the table. Yes. And honestly, I feel like if an advisor is completely ignoring housing wealth, and so as I've gotten deeper into this, the advisor relationships that I have are really, there's a lot of mutual respect there because, I think historically they'll look at our industry as loan officers and say, well, you guys aren't at the same level as we are as financial advisors. A lot of financial advisors, they're in charge of a lot, and a lot of them think they know everything. Like I did when I learned about reverse mortgages in 2014, and was blown away. So it really is, just kind of getting them to open their mind and just evaluate a couple of case studies. I mean, once I do that with an advisor, we look at, I always advocate. Let's take a look at somebody's scenario that has a paid off house. Let's look at somebody's scenario that has, 50 to 70% equity in the house. And let's look at both of those, scenarios, and you can put it into your financial planning software and model out their probability of success. And in every case, pretty much, their probability of not running out of money is greatly enhanced with a reverse mortgage versus not having it. I mean, it's night and day. And that's really what it's all about. I mean, seniors' biggest fear isn't dying. Right. It's running out of money. Yes. Yeah. And obviously some people aren't necessarily worried about running out of money. It takes a lot to basically say, I have absolutely no fear of running out of money. But but that's the biggest fear. And if we can enhance the probability of, you're going to have a 60% probability of success without the reverse, and it's going to be 98% with the reverse, why wouldn't you do that? And why wouldn't you plug that into the financial plan, right? At least look at it.
Right.
And so what I advocate to these advisors is, let's just look at a couple of scenarios. I don't need somebody's name. I don't need to know who they are. I just need to know how old they are.
Yeah.
What their house is worth, what their bucket 2 looks like, what's their retirement nest egg consist of, what's their income consist of, and then just have an educated conversation. For the most part, advisors are blown away because they just don't know what they don't know.
Well, that's the thing, is like, we all are served better because we learn from each other. And sometimes you can be I'm sure you've had scenarios like this where I know this is where I always say, like, my colleagues are my greatest assets, because we can get so in our head when we're in a scenario and trying to work through it. Same with the financial advisor. They're working on this plan. They're thinking about it one way. But then when you bring in another outside professional that has just a different take on it, or says, why don't you look at that aspect or tweak that? And you're like, whoa. And it's gratifying when you can do that and a light bulb goes on. Yeah. And it's like, whoa, we can really make some big progress in helping these people. And a lot of times for clients, they don't know. That's why they rely on us. That's why they rely on us. That's why they rely on their financial advisor, their CPA, because they don't know what's possible. And I think that these educational seminars that you guys offer every month, I invite my financial advisors, my realtors to them regularly. And I've had incredible feedback where they've said, wow, I had no idea that it's a great tool for their business. Because at the end of the day, we all are here to serve our clients the best that we can. That's what we're all trying to do. So I also I would love to have you talk about the book.
Oh, yeah.
Because this is so unique. I mean, how many reverse mortgage teams have their own published book?
Right. Yeah.
Yes.
Yeah. So the book is Home Equity and Reverse Mortgages. Harlan.
Love it.
So our director, this is who I met, in 2014. He wrote this book a handful of years later. He's actually working on a new book right now.
Oh my gosh.
It's a little bit more up to date, but he calls it the Cinderella of the baby boomer retirement. And, it really is, it deserves a place at the ball, kind of like Cinderella did. That's how he explains it. And if anybody wants a free copy, definitely reach out to Carice or I, and we'll send you a free copy of the book. It's a very easy read, and it's written more along the lines of, this is why you would, want to consider doing it. And he talks about it being, the Swiss Army knife of retirement income tools. And there's even a chapter in there called Sex, Drugs, and Reverse Mortgages.
Oh my gosh, that's awesome. I love it. I love it.
Because of the negative connotations, right? That anything can have. Reverse mortgages at first, they weren't as good as they are now. And anything can be good or it can be bad, right? It just depends on the use and the scenario. But it's an entertaining read, and definitely happy to send a copy to whoever would want one.
We'll make sure we'll put a link in this podcast, and people just can direct message me book, and we'll make sure we get them a copy of it along with your information. Oh my gosh, you've been such a wealth of information. Like I think that there's some gems in here that people will really, really pick up on. And this will definitely help some people out there that don't know anything about this, or maybe are under some misconceptions. So I can't even tell you how much I appreciate you sitting down and talking with me today. I have been fascinated. I like to attend, usually at least once or twice a year, I'll attend one of the great seminars that your team and Harlan puts on. And I always learn something new. even after 25 years, like I learned something new. And the one that you had for us last fall, I felt like that's where it kind of all gelled for me. And now, I feel like I do a better job as a loan officer, a forward loan officer, when I'm listening to my clients tell me their stories. I'm listening like, is the forward the best option? Should I be referring them to have a reverse conversation? So I feel like it helps us as professionals really key into those scenarios, questions we should be asking and listening for to best serve our clients.
Yeah.
Yeah.
Well, thank you so much for having me and for the opportunity. I don't get out and do this, do this every day. I'm a big believer in options for clients. So, if a client's old enough, then, why not look at both options and just let them choose what makes, there's obviously the option of a regular mortgage or reverse mortgage or paying cash for the place. That's kind of what it comes down to. But thank you so much for having me.
Oh my gosh. Well, thank you for coming on. And this will be great. There's a wealth of information in here. So phenomenal. Thank you.
Thank you.
Well, thank you so much, everybody, for listening today. This has some phenomenal information that Michael has shared with us. As always, if you enjoy the content, please like, share, and subscribe. And please direct message me if you would like a copy of the book that Michael talked about. It's a wealth of information, and we're happy to send you a copy.